Right. So welcome. Let me make sure that this is recording as well. Oh, where is it? Zoom again? Excellent. And again, thank you for being able to join. You are participating in day 22 of our The Empowered Launch. So being able to launch your business in an effective way and also fine tune existing businesses. We're touching on 24 different topics of your business operations. Today, we are touching on the balance sheet. And so tomorrow we're going to be touching on the full cash flow projections. There's a spreadsheet template that we've been working from. So we'll put that into the chat or into the description if you don't have a copy of it. And then the final 24th day, we are bringing it all together to create our executive summary. But that is actually not the last day. The last day is the 25th, where we're going to invite you to the ACBN anniversary. We're going to do a quick session at 3 o'clock just to thank everyone. So if you want to come get some food, definitely join us in Brampton or hop online where we're going to talk about just how this has all come together and where you feel your business is. So again, I do thank you for being here today. We are going to be talking about the balance sheet. So as I mentioned, the cash flow projections spreadsheet, I will put that into the chat again just so that you have it. And we'll talk about how the cash flow projections does integrate into the balance sheet. And let me share my screen. And then tomorrow we're going to be doing a deep dive on the entire cash flow projections. So please do start your homework, at least put in your startup costs so that you're not starting from scratch. But we'll do a walkthrough regardless. So a quick overview, we're going to be talking about the balance sheet, and I'll show you a current balance sheet that I have so that you can see the different elements. And also, just to get started, we're going to watch a bit of a review. I liked how they did a review of this balance sheet. So we'll watch this and then we'll dive into it.
Imagine if you could quickly tell if a company was a financial fortress or on the verge of. The Balance Sheet Overview by Brian Feroldi. The balance sheet's purpose is to track what a company owns and what it owes to others. It's kind of like your own personal net worth statement. It's a point-in-time snapshot that's taken on a specific day, and it uses accrual accounting. The balance sheet has three major components: assets, which are everything the company owns; liabilities, which are everything the company owes; and shareholders' equity, which is its net worth on paper. Assets are listed in order of liquidity, which is how quickly something can be converted into cash. There are two major categories: current assets, which are expected to be used or consumed in less than a year, and long-term assets, which are expected to benefit the company for more than a year. There are two major categories of liabilities: current liabilities, which are expected to be paid back in less than a year, and long-term liabilities, which are expected to be paid back in more than a year. Finally, there's shareholders' equity, which is the amount of capital that investors have put into the business and the business has retained. Now, the balance sheet is called the balance sheet because assets must always exactly equal liabilities plus shareholders' equity. The Balance Sheet Overview by.
Excellent. So let me pull up an actual balance sheet here. So to give you an idea of what you should be tracking with your balance sheet. And again, your accountant is typically best to support you with this because they would be doing your year-end statements, so your income statement and your balance sheet. But make sure that they sit down and actually walk you through what it means and what each section means. So as you noticed, the assets, and typically that's sectioned into current assets and long-term assets. So current assets, typically the money you have in the bank, accounts receivable that you might have. Long-term assets is typically like your vehicle, if you own a building, those would be long-term. And then with your liabilities, that's usually your accounts payable, bank loans, credit cards, those would be current. And then long term, if you do have, I think it's usually over 3 years, then it would be a long term liability if you have a loan that is over 3 years in length. So any long-term debts, vehicles, buildings, those mortgages would be considered long-term liabilities. Now, the retained earnings and the equity section, the shareholders' equity, that's typically where entrepreneurs we don't pay attention to. So the money that you're putting into the business needs to be captured somewhere because in order for everything to balance, if you're putting in money, that creates an asset. So now the counterbalance to that asset has to be captured somewhere. So typically it's in the share the retained earn the shareholders equity section so that your balance sheet it, it it evens out. So that's where you want to sit down with your accountant to understand how are you investing in your own business. So if you get a bank loan, usually it would show so the cash is going to come into your account and then the liability is going to go onto the current liability section. Or if it's a 10-year loan, let's say it's a 1-year loan. So you're getting this loan from the bank, you're now going to have cash come into your account. So you'll have cash in the bank. And then the counterbalance to that is the current liability. So now, if you just put money into the bank, that money isn't captured in the liabilities because you are not loaning, you're not an entity that's loaning to yourself. That's why it has to be captured in the shareholders' equity so that you know where it's balanced. And then in the future, you'll know how you get to kind of get repaid based on the money that you've put in. But if you're not tracking it, then it's difficult to fall. Like you wouldn't be able to know how much you've put in for one thing, and then how to get repaid, which is another question about when I talked about the in this section, the shareholder equity, you need to track it so that you can reconcile. Because a lot of times you'll be running the business and money seems to just be flowing away from you. A lot of times you're using your savings and or using your personal credit cards or your personal bank account. All those things of where the money is coming from is not going to be captured on your business statements. Because if you're using your own personal money, that's not captured on your balance sheet. So that's why it's put into the shareholders equity section. And then if the company does have profits, that profit is typically captured in the retained earnings. So you want to understand that income statement. If it is profitable, you need to know what you want to do with that money. So a lot of times the conversation with your accountant is now, okay, there's excess in the company. We need to figure out what to do with it. Is it going to be paid out in a dividend? Is it going to be paid out through a salary to the owner? Or is it going to be an owner's draw so that the retained earnings or the shareholder equity would be reduced based on the amount that you had put in so that it balances? So again, these are all questions that you need to have with your accountant. Typically, these come up more with corporations. So if you have a sole proprietor, you should still track it, but usually you're filing a tax return based on your personal income taxes anyway. So the accountant kind of everything is based on you as an individual if you're a sole proprietor. But if you have a corporation, then you need to know how the corporation is going to deal with you and how to pay you. So these are all things that you need to map out ahead of time. You don't want to be trying to figure it out on the fly. So talking to an expert, a person that is an accountant, or at least your bookkeeper can give you some guidance is very helpful. And that's where we wanted to talk about some of the stuff on the cash flow projections that would show up in your balance sheet as well. But just before I jump to that, let me just pause real quick. Did anybody have any specific questions about the balance sheet and how it is, like how certain things are calculated or how it would affect your business? So I don't want to go too quickly because I know the balance sheet is not something that we're looking at every day, but I would touch base with your bookkeeper or accountant just for them to refresh, give you a refresher on how things are looking on your balance sheet. So because the balance sheet really shows if the company is healthy. A lot of the ratios that banks might use when you're trying to get loans is looking at the ratio of like debt over assets or revenue or debt over revenue to see if you're bringing enough revenue to service debt and how much is on the balance sheet that might be called right away. Because if you have bank loans that could get called, they want to know is there enough money in assets or in cash to be able to pay off that loan at any given time. So those are kind of the risk factors that banks might put your business through to show is this company liquid enough to cover anything that might happen, like a bank call on your loan. Because, for example, if the bank loans you $20,000, even though you're paying it monthly, they can actually call that 20,000 at any time. And so if you might not have 20,000 in the bank, but you have $20,000 equity in your home or a $20,000 vehicle, if they do call it, they know you have assets to be able to pay it. So those are some things that underwriters look at. So you might notice if a bank is looking at your financial statements and they're declining you because they think that you're risky, you definitely want to do a review of your balance sheet because the income statement is going to show if you're profitable, but the balance sheet shows the health of the business. Because even if money's coming through, if you owe too much and can't pay that based on the assets you have, that is high risk for the banks to lend to you. So let me just hop over. And I apologize, I wasn't looking if there was any hands raised. So if your hand is raised, or if you just want to unmute if you did have a question. Otherwise, I'm going to touch on the cash flow projections. So you'll remember with the cash flow projections, we talked about the startup costs. So again, depending on where this money is coming from for the startup costs, you want to capture it. It will be captured in your balance sheet, but you want to understand how it's captured. So for certain things, we looked at like different elements that you'd have to pay for. Now, some of these are going to be expenses that are on your income statement, and then some of these are going to be actual assets that are on your balance sheet. So when we look at a virtual office, that's going to be an income statement expense. When we look at the internet you're paying for, that's going to be income statement expense. But the equipment that you buy would actually live on your balance sheet. So that would be an asset, and typically it would be a long-term asset. And what they do with it is depreciate it over time. So when you look at marketing or internet, those things, it's expensed right away. But when you have things on your balance sheet, it's actually expensed over time. So now when they amortize it, usually they do straight line to make it simple. So let's say this $2,500, they would depreciate it over 10 years and it'd be straight line. So 10 years divided by the 2,500. So every year, the equipment reduces in value by $250 until on paper it's worth nothing. So that's where the expense is realized. So things like cleaning supplies. Now, cleaning supplies would be expensed through the cost of goods sold. Because when you first buy, so for detailing nights, when we first buy our waterless car wash, for example, that goes into inventory, and then the inventory lives on our balance sheet because it's sitting there until we use it. Once we start using the waterless car wash, as it's depleted, so every car that we clean, it depletes some of the supplies. So it's captured on the income statement as the cost of goods sold for the sales that we did. And then it's reconciled kind of at, it could be monthly or at the end of the year to say how much supplies did you start with, how much sales did you have that would use the supplies, and then how much did you have at the end. And that difference is what's reduced in your inventory on your balance sheet. So a lot of calculations, but just know that things that you buy that you're going to use to produce the sale, that is sitting on your inventory and your balance sheet, and then it's reduced through your cost of goods sold. And again, really great to be able to sit down with your bookkeeper or accountant and understand the flow of money in your company, because now you might have all this inventory on your balance sheet and it looks great because your balance sheet assets are high, but then as it's used, like it's not being used though. So inventory sitting on your balance sheet does not translate to sales. Like you want to get that out of your inventory and then purchase more and replenish it. So we want to be looking at, yeah, is inventory moving? Because if we have too much inventory and it's not moving, then something's wrong with our marketing and our sales strategy. So just things to think of, stuff like the business registration, business bank account, the booking calendar, those would be expensed right away on the income statement. But then when we look at something like the vehicle, so if we're buying a Prius, that asset would sit on our balance sheet and then it would be amortized over time. And again, it would be usually they use straight line. So every year it's amortized at a certain amount. But sometimes with vehicles, they say, oh, those amortize quicker at the beginning and then less at the end. So they sometimes use something called, oh my gosh, double declining balance. So it actually amortizes more at the beginning, and then the older it gets, the less it amortizes. So it's not just a straight line. Hey, things that you can discuss with your accountant over uh, dinner or lunch, that different ways to amortize equipment or vehicles. I'm sure they would love to have conversations with you. But for yourself, again, I usually try to keep things simple, straight line. You would determine how many years of usefulness a vehicle or equipment would have, and then you would divide it by the amount that you paid for it. All right. And so you'll notice that the Prius, so up front, let's say you're going to lease or finance the vehicle. So if you're going to lease the vehicle itself wouldn't be an asset because the company doesn't own it. It would actually just be those expenses being um, on your income statement. Every month. It would be an expense of the lease payment. When you finance it and you actually own it, that's where the asset would be on your balance sheet. So you wouldn't be writing off the payments. You would actually be decreasing the value of the car or the vehicle over time. So these are things that, and then other ways to recoup expenses from your vehicle would be like the mileage that you put on it, or like these are all conversations that you want to have with your accountant because it affects how much taxes you pay if you're not capturing all of these deductions. So you're using your vehicle for work and you're paying payments on it, you own it, it should show up as an asset, and then how much you're using it should show up as a expense so that you can reduce income that you're the amount of income that you're declaring on your income tax. Again, a lot of conversations to have with our accountant, but definitely bring up the vehicle one because that's one that I've noticed a lot of entrepreneurs miss. And the vehicle deductions can be quite lucrative. I think the Canadian government does it about 55 cents per kilometer. So if you look at how much kilometers you've driven for this past year, and you could have deducted 55 cents, and don't quote me, it might be 52 or 55, but you could actually reduce your cost of your income tax by the amount that you're driving and that cost that you're incurring. So again, a lot of conversation when you sit down with your bookkeeper and accountant. If they're not talking to you about these things, you might want to switch bookkeeper or accountant because you're leaving a lot of money on the table. Just going to like a tax filing company and them taking you through a template that misses certain things that are key for your business will cause you to pay a lot more in income tax, and you're losing out on these deductions. So, and another thing to think of, if you did have a year where you lost money, that money that is a net loss on your income statement can actually be carried forward to the next year. So if you have profits the next year, it would reduce by the losses the previous year. Again, a lot to take in, but remember to have these conversations with your accountant because it might take a couple years to get the business profitable, but those losses you can actually use as an uh, a way to reduce your income tax in future years. I think you can go back as much as 3 years of losses to pull it forward. But all that to say, note that down as something to talk to your accountant or bookkeeper about, because you want to make sure that you're utilizing these advantages. There's these tax advantages that you can tap into. So right here, where it talked about the owner's contribution. So this full startup cost, if I was going to come out of my savings and not take, so if I put it, let's say right here, 38.55. So you'll notice that money coming out of my savings bank account, that would be put into shareholders' equity. And then the asset would be the cash that I'm putting into the bank to make all of these purchases here. So now, if I didn't have the money and I had to delete this section, and you'll see now I have to go get a loan. If I needed to take a loan out to purchase all of these startup costs, the loan would go into the balance sheet as a liability, and then the cash that I get from the loan would go as an asset, and then you're using it to make these purchases. So again, if you're using your savings, I would definitely document it and then talk with your accountant about how to capture the money that you've invested into this business in the shareholders equity section. And then you'll notice it calculates the monthly payments. So that's why a loan actually doesn't just sit on your income statement. So the payments that you make would be the expenses, an expense line item in the income statement, and then that's reducing the liability on your balance sheet. So again, just ways to track what's happening in your business. So the bank would then see, okay, on your balance sheet, the loan is a certain amount because every month you're paying it down. So they want to see what's left on the principal. And then I think that because the interest you get to write off. Again, another conversation with your accountant. So the other piece, well, the cost of goods sold. So this is captured in the income statement, but then the supply. So if you have inventory, you're calculating how much is used per sale, which gives you the cost of goods sold. But then the remaining inventory or supplies that you have, that difference between how much you started with and how much you ended up with is what's captured on the balance sheet. So you would see how much inventory you have left, and then it's captured in your cost accounting. So when we're doing these exercises, that's why it's a lot of front-loaded work, like calculating the cost of goods sold and how much supplies you're using or how much inventory you're using. When we do it all up front, then it saves you from losing out on tracking your inventory properly or how much your balance sheet is actually reflective of the assets that you have. We have to, like, if you just make an accountant do it for you, you're going to lose out on really understanding what's happening in your business. So when you know every sale that you make is affecting your inventory in a certain way, and then if there's too much inventory left over, hey, you might have to have conversations about your pricing or your marketing strategy. There's so much conversations that can have when you know your data. So doing this work up front, and again, I don't pretend that entrepreneurship is not hard. I do not pretend that it can be complex, but leaning into complexity sometimes will save you in the long run. Because if we skip this work and we just keep operating and we're not looking at the numbers and we're not understanding how what it costs to actually run this business, we're going to lose out at the end because we're going to notice our bank account is a lot lower than it should be. And so we want to support you in making sure that doesn't happen. So definitely book a meeting with one of our consultants from ACBN or with Empowered Forex directly to really get support on how to put all this together. Because over the 24 days, it's a lot of information coming in, but know that we are actually here to help guide and point you in the right direction. We have accountants and bookkeepers on our roster. We have legal support. We have people that can help with marketing and sales. We have people that can help with operations and, hey, implementing AI. So there's a lot of different moving parts with your business that you can get support for. So please do lean in and do not feel like any question is a bad question or a dumb question. We're all learning together. This is a lifelong learning journey. And the more that we can learn and share with each other, we just shorten the time frames on learning certain things so that we can then focus on bigger things as our companies are growing. So I do want to pause there. I'll see if there's any questions before we wrap up for today. Am I not hearing?
Talk about that big announcement that was made yesterday or Monday about the funding and how we can position our companies to be able to tap into some of that funding engagement.